Unemployment doesn't announce itself with sirens. It arrives quietly while headlines insist everything is fine. Job postings stay up, paychecks still clear, and the data looks stable. Right up until it doesn't. Behind the scenes, hiring has already stopped. Wages have stopped protecting people, and entire industries are preparing to cut without saying a word. This is how every major labor collapse begins. Not with mass layoffs, but with silence. By the time unemployment shows up in the numbers, the damage is already done. The exits are gone, and millions of households are left reacting instead of preparing. Rate cuts are framed as stimulus, but in reality, they mark the moment policymakers realize something is already breaking. When interest rates are lowered while inflation remains elevated and fiscal deficits still exceed $1.5 to $2 trillion annually, the signal is not confidence. It is concern. Central banks do not cut preemptively during strong labor expansions. They cut when internal indicators suggest employment stress that has not yet surfaced in the official numbers. The key point is this: cheaper money does not create jobs when confidence is gone. A 25, 50, or even 100 basis point cut does nothing if companies doubt future demand. Hiring is a long-term commitment. Payrolls are not adjusted quarter by quarter like interest expenses. When executives see slowing revenue, compressed margins, and weakening consumption, they pause hiring regardless of where rates sit. That is exactly what is happening now. Policy rates were pushed above 5%, then cuts began as growth momentum faded. Yet hiring did not rebound. Payroll growth slowed, full-time employment weakened, and prior job gains were revised downward. In previous cycles, rate cuts preceded job growth by a short lag. This time, months have passed with no response. That divergence matters. It means monetary policy has lost traction over labor. This is why rate cuts function as damage control, not rescue. The mandate is employment stability. When internal labor indicators deteriorate, easing begins even if inflation risks remain unresolved. But easing cannot reverse a hiring freeze that has already taken hold. It can only soften financial stress. By the time cuts approach 100 to 125 basis points, the slowdown in labor demand is usually advanced, not early. That reality pushes the system into its next phase. If lower rates fail to restart hiring, the problem is no longer financing conditions. It is expectations. Businesses are not waiting for cheaper capital. They are waiting for certainty that demand will justify expansion. Without that certainty, hiring stalls. And once hiring stalls, the math turns brutal. Labor markets do not need mass layoffs to weaken. They only need expansion to stop. Attrition alone becomes contraction. This is how unemployment surges later, suddenly, long after the first rate cut convinced the public the danger had passed. When rate cuts fail to revive hiring, the labor market doesn't crack loudly, it goes quiet. This is how modern employment cycles actually break, not through immediate layoffs, but through inaction. Companies stop expanding, stop backfilling, and stop committing to new payroll costs. On the surface, employment appears stable. Underneath, momentum is already gone. A hiring freeze leaves almost no immediate footprint in unemployment data. Job postings stay visible. Payroll counts barely move. But the economic damage is real. When a firm cancels plans to hire 20, 50, or 100 workers, those wages never enter the economy. At an average, fully loaded cost of $75,000 to $90,000 per employee per year, each frozen position removes hundreds of thousands of dollars in future household spending. Multiply that across thousands of firms, and the loss quietly reaches into the billions. Net job growth depends on new hiring, not simply on avoiding layoffs. When hiring rates slide, job creation mathematically collapses even if companies are still operating. Recent data shows hiring activity falling toward levels normally associated with downturns, while job openings remain elevated. That divergence is not a sign of strength. It is hesitation. Openings that do not convert into hires signal uncertainty, not opportunity. The financial logic behind the freeze is unforgiving. Hiring is a long-term obligation. Wages, benefits, payroll taxes, and training lock companies into multi-year commitments. When revenue growth slows, margins compress, and demand becomes unpredictable, those commitments turn into liabilities. Cutting planned hires protects cash flow without triggering layoffs or bad press. That is why freezes spread silently across sectors before any official contraction appears. As freezes persist, labor conditions tighten without a single termination notice. Entry-level roles vanish. Internal promotions stall. Workers who do lose jobs face fewer openings and longer searches. Underemployment rises as people accept part-time or lower-paying work simply to stay afloat. Wage leverage erodes even for those still employed because alternatives disappear. This also explains why easier monetary policy stops working. Lower rates reduce interest costs, but they do not restore confidence. A firm uncertain about future demand will not expand payrolls simply because borrowing is cheaper. That hesitation becomes systemic, especially in service-heavy and white-collar industries, where labor is the primary cost. Over time, the arithmetic shifts. Attrition replaces expansion. Retirements, resignations, and restructurings are no longer offset by new hires. What began as caution turns into contraction without fanfare. By the time layoffs finally surface in the data, the hiring freeze has already done the damage, and the labor market is far weaker than the numbers suggest. Once hiring freezes take hold, the next illusion forms around unemployment itself. The unemployment rate does not reveal labor damage in real time. It confirms it after the damage has already spread. This delay is not accidental, it is structural. Unemployment only counts people who have lost jobs and are actively filing claims or seeking work. That definition creates a timing gap between labor stress and labor visibility. When companies stop hiring first, displaced workers do not immediately appear in the data. Severance packages delay filings. Contract extensions postpone separation. Gig work absorbs shock temporarily. The result is a labor market that is weakening internally while the headline number barely moves. This delay matters because it creates false confidence. A labor market can lose momentum for months while unemployment remains flat. During that period, reemployment probabilities collapse. Workers who lose jobs face fewer openings, longer searches, and lower wages, but none of that registers immediately. The unemployment rate only rises after the system has already tightened beyond recovery speed. The math explains the lag. If a worker receives 8 to 16 weeks of severance, unemployment claims are postponed by months. If another worker accepts short-term contract or gig work earning a fraction of prior income, they remain statistically employed. If discouraged workers stop applying because rejection rates spike, they disappear from the labor force entirely. None of these outcomes signal strength. They signal concealment. At the same time, job losses accumulate quietly. Even modest monthly net losses, 50,000 to 100,000 positions, compound rapidly when hiring is frozen. But because attrition replaces expansion, the unemployment rate understates pressure. It is not measuring labor demand, it is measuring delayed distress. This is why unemployment spikes feel sudden. The damage does not happen suddenly, the recognition does. Once severance runs out, contracts end, and savings thin, claims surge together. That is when the unemployment rate jumps from stability to acceleration, often by 100 to 200 basis points in a short window. By then, policy response is already late. The connection to the hiring freeze is critical. When new jobs disappear, displaced workers have nowhere to go. The labor market loses its shock absorbers. What looks like resilience is actually rigidity. Replacements stop. Matches fail. Time becomes the enemy. This is why relying on unemployment data alone is dangerous. It is a backward-looking indicator in a forward-breaking system. By the time it confirms trouble, the labor market has already shifted from slowdown to structural weakness, and the conditions for a sharp surge are already in place. Because unemployment confirms damage late, the real warning signs appear elsewhere. Labor markets fracture first through indicators that measure difficulty, not displacement. These signals turn long before the unemployment rate reacts, and when they move together, recovery odds collapse. One of the earliest cracks appears in the balance between jobs that are plentiful and jobs that are hard to get. When this differential compresses towards zero, it signals that workers are losing bargaining power even if they remain employed. Historically, readings below the low single digits have aligned with rising unemployment within the following quarters. This shift reflects perception, but perception governs behavior. When workers believe jobs are scarce, mobility dies, wage pressure weakens, and risk tolerance vanishes. Next comes reemployment probability. In healthy labor markets, displaced workers are absorbed quickly. When that probability falls, job loss becomes sticky. Average job search durations lengthen from weeks to months, then from months toward a year. Each additional month out of work compounds financial stress and reduces the likelihood of returning to prior income levels. This deterioration happens quietly, but it determines how severe the next unemployment wave becomes. Underemployment is another early fracture. Hours are cut before headcount. Full-time roles are replaced with part-time arrangements. Workers remain employed statistically while losing income, benefits, and stability. This reduces aggregate wages without triggering layoffs, pulling demand down invisibly. When underemployment rises alongside falling reemployment odds, the labor market is no longer flexible. It is brittle. Job-switching data delivers another warning. In strong markets, voluntary quits are high because workers can trade up. When quit rates fall, it means people are staying put out of fear, not satisfaction. That fear signals collapsing confidence in outside options. Wage growth slows, not because pay is cut, but because leverage disappears. Even modest raises fail to offset rising costs, weakening consumption further. Finally, hiring intensity matters more than job openings. Openings can remain elevated while hiring collapses, creating a false picture of opportunity. What matters is conversion. When firms post roles but delay or cancel fills, labor demand is signaling retreat. Each unfilled role represents income that will never be earned, spent, or saved. These indicators do not operate independently. When difficulty finding work rises, reemployment probabilities fall, underemployment increases, quits decline, and hiring conversion weakens at the same time, the labor market has already shifted phases. At that point, unemployment is not a question of if, but when, and how fast. This progression explains why unemployment appears to surge without warning. The warning was always there. It simply arrived through indicators most people never see, long before the headline number finally caught up. When early labor indicators fracture, wages are supposed to act as the buffer. In past downturns, rising pay helped workers absorb shocks while the job market recalibrated. This time, that buffer is gone. The wage system is no longer protecting households, it is amplifying risk. Nominal wages still rise on paper, but real wages have been stripped of meaning. With cumulative inflation exceeding 20% since 2020, most income gains have already been absorbed by higher housing, food, insurance, and energy costs. A 3 to 4% annual raise sounds positive until it collides with rent increases of 8 to 12%, insurance premiums rising 15 to 25%, and grocery costs that are structurally higher than pre-pandemic levels. The result is silent erosion. Workers are technically earning more, yet falling behind every quarter. This changes the nature of job loss. In a system where wages track living costs, unemployment is disruptive but survivable. In a system where wages lag permanently, job loss becomes immediately destabilizing. Households no longer have margin. Savings rates have collapsed toward historical lows, while revolving credit balances now exceed $1.3 trillion nationally. That means a lost paycheck is not a pause in consumption, it is a break. This is where the labor market shifts from fragile to dangerous. When wages fail to build resilience, unemployment does not unfold gradually. Workers cannot wait out a weak market. They are forced to liquidate savings, rely on credit, or exit the labor force entirely. Each option weakens demand further, feeding back into corporate revenue and reinforcing the hiring freeze already in place. Wage stagnation also distorts labor behavior before unemployment even rises. Workers cling to jobs they would otherwise leave, reducing mobility and freezing wage competition. Employers gain leverage without cutting pay simply because alternatives disappear. That suppresses income growth across entire sectors, not through layoffs, but through inertia. Paychecks keep coming, but they stop advancing. The danger is cumulative. When wages stop functioning as shock absorbers, the labor market loses its ability to self-correct. A displaced worker cannot accept a temporary downgrade without permanent damage, because lower pay no longer covers fixed costs. That increases the duration of unemployment and raises the probability that job loss becomes long-term. This connects directly to what comes next. When wages no longer support consumption, economic growth must be propped up elsewhere. Spending does not stop immediately. It is shifted forward through savings drawdowns and debt expansion. On the surface, activity continues. Underneath, household balance sheets deteriorate rapidly. When wages stop protecting households, economic growth does not immediately disappear. It mutates. Output continues, spending continues, and headlines stay optimistic. But the source of that activity changes in a way that quietly destroys resilience. Growth no longer comes from rising incomes. It comes from balance sheet depletion. This is how an economy can appear healthy while households deteriorate. Consumption is increasingly financed by savings drawdowns and debt expansion, not wage growth. Since 2020, excess savings have been largely exhausted for middle and lower income households, while revolving credit balances have surged past $1.3 trillion. Buy now, pay later usage has exploded. Auto and personal loan delinquencies are rising even as spending persists. The activity is real, but the foundation is not. This creates a dangerous illusion. Gross domestic product measures transactions, not sustainability. A dollar spent using credit counts the same as a dollar earned through income. When households replace wages with borrowing, GDP can rise while financial stability collapses. That is why growth can print 3 to 4% even as real purchasing power weakens and labor stress spreads. The economy looks alive because future demand is being pulled into the present. The distortion deepens when inflation masks fragility. Higher prices inflate nominal spending totals, boosting revenue figures without increasing volume. A household spending $120 for the same groceries that once cost $80 contributes to growth, even though their standard of living has declined. Multiply that effect across housing, insurance, utilities, and healthcare, and economic output rises while lived conditions worsen. This is why growth no longer signals strength. It signals extraction. Households are compensating for inadequate wages by liquidating savings and absorbing debt. That behavior sustains consumption temporarily but erodes the ability to withstand shocks. When a job loss occurs in this environment, there is no buffer left. The system has already consumed it. From a corporate perspective, this growth is untrustworthy. Businesses see revenue, but they also see margin pressure, rising defaults, and slowing volume beneath higher prices. That is why investment hesitates and hiring remains frozen even during reported expansions. Companies understand that debt-funded demand is unstable. They do not expand payrolls based on it. This connects directly to the next break. When growth is sustained by household deterioration, it eventually collides with reality at the business level. Consumers pull back not because they want to, but because they must. At that point, revenue drops quickly, not gradually. The economy does not slow because growth ends. It slows because the source of growth collapses. And when that happens, the impact shows up first where demand meets labor. In businesses that can no longer justify staying open, when growth is sustained by households draining themselves, the stress does not surface first in unemployment data. It surfaces in business closures. Closures are the most honest labor signal in the economy because they reflect final decisions, not intentions. A business that closes is not waiting for demand to recover. It has already concluded that recovery will not arrive in time. This is why closures matter more than layoffs. Layoffs can be reversed. Hours can be restored. Hiring can resume. Closures erase jobs permanently. They remove payrolls, eliminate local demand, and destroy future hiring capacity in one step. Each closed location represents not just lost employment, but lost income streams that supported entire communities. The scale is already alarming. In a recent year, more than 7,000 retail locations closed nationwide, the highest outside of crisis periods. The following year began with over 6,000 closures in just 6 months, putting the pace above 12,000 annually, exceeding levels seen when the economy was partially shut down. This is happening without lockdowns, without emergency restrictions, and without an external shock. That alone should reset expectations. Closures accelerate when debt-funded growth collides with cost structures that no longer work. Rents reset higher, labor costs rise. Inventory financing becomes more expensive. Meanwhile, consumers are increasingly price-sensitive and less forgiving. Margins compress from both sides. When revenue depends on households already stretched thin, businesses lose their ability to absorb volatility. The weakest locations go first, then the marginal ones, then entire chains begin retreating. This is where labor damage becomes structural. A closed store does not rehire when conditions improve. A closed restaurant does not reappear when rates fall. The jobs are gone. Entry-level positions vanish. Part-time roles disappear. Scheduling flexibility collapses. These losses rarely show up immediately in unemployment figures because workers disperse into gig work, temporary arrangements, or exit the labor force entirely. But the employment base has been permanently reduced. Closures also act as a multiplier. Each one removes not just direct employees, but secondary demand for suppliers, logistics, maintenance, and local services. A single retail shutdown can erase millions of dollars in annual economic activity when indirect effects are included. As closures spread, entire commercial corridors hollow out, reducing tax revenue and weakening municipal finances. That feeds back into public services, infrastructure spending, and local employment. Crucially, closures reveal something hiring data cannot. Confidence is gone. Businesses do not close because demand dipped for a quarter. They close because forward visibility has collapsed. When owners conclude that consumers cannot sustain spending and costs will not normalize, the decision becomes irreversible. That is why closures often peak before unemployment does. They mark the point where adaptation ends and retreat begins. This ties directly into the next phase. When businesses disappear, the labor market loses its shock absorbers. Workers displaced from closed firms face fewer alternatives, longer searches, and lower wages. At the same time, remaining businesses become more cautious, reinforcing freezes and accelerating consolidation. The system tightens rapidly. Unemployment does not rise because closures occur. Closures occur because the conditions that prevent unemployment from rising no longer exist. Once that threshold is crossed, the labor market does not weaken gradually. It snaps. Once business closures spread, the labor market enters a self-reinforcing phase where weakness no longer moves in one direction. It loops. What begins as caution turns into acceleration, and unemployment no longer rises slowly. It surges. The mechanics are brutal. Closures remove jobs permanently, which reduces household income at the local and national level. Lower income forces spending cuts, not by choice, but by necessity. Those cuts immediately hit remaining businesses, especially in discretionary categories. Revenue drops, margins tighten, and firms that were already fragile are pushed to the edge. More closures follow. Each round amplifies the next. This is how unemployment becomes nonlinear. A single closed location might eliminate 30 to 50 jobs. A chain retreat can erase thousands at once, but the secondary impact is larger. Suppliers lose contracts, logistics volumes fall, commercial landlords lose tenants, municipal tax receipts decline. Each of those pressures translates into additional job losses outside the original sector. The system compounds itself. At the same time, households lose their remaining buffers. With savings already depleted and revolving credit balances above $1.3 trillion, displaced workers have limited capacity to maintain consumption. Auto, credit card, and personal loan delinquencies begin rising together. When defaults increase, lenders tighten standards. Credit becomes harder to access just as more people need it. That restriction feeds back into demand, accelerating revenue declines across the economy. Labor behavior shifts sharply in this phase. Job searches lengthen. Reemployment probabilities fall. Workers accept lower pay or exit the labor force entirely. Participation drops not because opportunities improve, but because failure rates rise. This suppresses the unemployment rate temporarily, masking the scale of distress, even as income loss spreads. When claims finally surge, they do so all at once. Policy responses struggle to keep pace. Rate cuts lower borrowing costs, but they cannot reverse closures or restore vanished demand. Fiscal support arrives late and unevenly. By the time interventions reach households, the labor market has already tightened beyond flexibility. What remains is damage mitigation, not prevention. The defining feature of this phase is speed. Early labor weakness unfolds quietly. This phase does not. Once the feedback loop is active, unemployment can jump 150 to 250 basis points in a short window. History shows that when labor markets enter this stage, recoveries become slower and more uneven because the employment base itself has been reduced. This is why unemployment spikes feel sudden and shocking. The surge is not the beginning of the crisis, it is the moment the system can no longer hide it. By the time the numbers confirm what is happening, households are already out of options. The economy is no longer slowing, it is breaking.